All right, today we're going to break down a huge financial story that's unfolding across the Pacific, and I'll show you why it could have a very real impact on your 401k and your stock portfolio. Let's dive right in. So let me ask you a question. What do you think is the biggest risk to your retirement account right now? Well, I'm willing to bet it's a danger you probably haven't heard much about at all. It's a risk that could affect everything from the interest on your house to the value of your investments. And here's the thing. This threat isn't coming from the usual places like Wall Street. Nope. This one is starting in Japan, and it turns out their financial health is connected to ours in a way that most people just don't realize. So what's the connection? Well, check out this number. Japan holds $1.2 trillion of U.S. government debt. That makes them our single biggest foreign lender. So yeah, when your biggest banker has a problem, you have a problem. Now, to really get why this is all coming to a head right now, we have to rewind the clock a bit. For the last 30 years, Japan has pulled off an economic magic trick, managing to stay afloat even while being the most indebted country on Earth. The problem is, that magic trick is starting to fail. I mean, just look at the sheer scale of this. Japan's national debt is a whopping 234% of its entire economy's output. To put that in perspective, people are already panicking about the US debt at 120%, and Japan's is almost double that. It's just off the charts. Let's make this personal for a second. Imagine you earn 50 grand a year. This is like you having over $117,000 in credit card debt. I mean, you'd be bankrupt, right? No person, and historically, no country, has ever survived this level of debt without a major crisis. So how on earth did they get here? Well, it all goes back to 1991. A gigantic financial bubble popped, and their economy just stopped. For 30 years, it went nowhere. They call it the lost decades. And the whole time, to try and jumpstart things, the government borrowed like crazy, while their central bank did something unheard of. They pushed interest rates to zero. And here it is, the magic trick. The Bank of Japan literally started printing money to buy its own government's debt. Think about that. It's like paying off your Visa bill with a MasterCard that you can just print in your basement. It's a wild scheme that somehow worked for 30 years, but now it's all coming apart. You see, this whole zero interest rate situation in Japan didn't just stay in Japan. It unleashed this massive global free money trade that has been secretly pumping up the price of pretty much everything, from stocks to houses, maybe even assets that you own right now. This thing is called the yen carry trade, and it's pretty simple, really. For years, big hedge funds could borrow Japanese yen for basically free, 0% interest. Then they'd swap it for US dollars and buy American bonds that paid, say, 4.5%. That difference? Pure profit. And with that free money, they'd go on a shopping spree for US stocks, real estate, crypto, you name it, pushing prices way, way up. And the size of this trade, it's hard to even wrap your head around. We're talking about an estimated $20 trillion. That is bigger than the entire US economy. So this isn't some tiny niche strategy. It's been a bedrock of global finance for decades. Okay, but now the party's over. The math that made this whole thing work is completely breaking down, and as this giant trade unwinds, it's sending shockwaves all the way from Tokyo straight to your wallet. So here's what's happening now. For the first time in forever, Japan's interest rates are actually starting to go up. So Japanese investors don't have to send their money abroad to make a return anymore. They can actually make money at home. This is causing a huge sell-off of US assets as all that cash starts to fly back to Japan. And when a giant player like Japan starts dumping US bonds, all that supply makes the price of those bonds fall. And here's the absolute key. There's a seesaw relationship in the bond market. When bond prices go down, interest rates go up. It's a law of financial physics. And look, this isn't just some abstract thing for Wall Street to worry about. The US government's interest rate is basically the foundation for all other interest rates. When it moves up, so does the cost of your mortgage, your car loan, your credit card debt. Everything gets more expensive. It puts the brakes on the entire economy. So the big question is, what do you do about it? Now, obviously, this is not financial advice, but the source material we're looking at today does give us a really interesting way to think about what might be safe and what might be at risk in this kind of environment. The basic idea here is to think about real, tangible value. The source suggests companies that actually produce physical things like energy and materials could be more stable. Also, brands that are so strong people will pay more for them even when money's tight. On the flip side, you might want to be cautious about companies that are loaded with debt, because that debt is about to get a lot more expensive. Same goes for companies that sell wants instead of needs. And this quote from the source just nails it, really. The idea is to focus on businesses that are essential, businesses that have real value, that customers absolutely need, and that they can't easily switch away from, even in a tough economy. So let's wrap this up. A huge, foundational piece of the global financial system is cracking. For decades, this free money trade has pushed up the price of nearly every asset you can think of. And now, it's reversing. The fact that you've watched this means you now understand this dynamic better than 99% of other investors out there. The only question is, what are you going to do about it? Thanks for watching.